Now, in this segment, we're going to go in more detail on inflation. Where are we seeing the inflation, and how is it going to impact overall as we start looking at those leading indicators kind of pulling us in a specific direction. So when we look at U.S. inflation versus ISM prices paid, so that's looking at headline CPI versus ISM manufacturing, and you can see just how different those numbers are. Now, they're not perfectly aligned. There's differentiating factors between them, and the CPI index is made up of other components as well. But you can see that the trajectory is heading in a very clear direction. If we look at ISM manufacturing prices paid, we're talking about something that is coming into that 82. So where is CPI going to go? And when you look at that 2.5%, that is a very doable number just looking at some of the movements that we've seen in previous cycles. So now let's look at rent. Okay, well, median asking rent year over year has gone way up, and the CPI primary rent has come way down. Now, it's asking rents have gone up depending on where you are. So in some places they've gone lower, especially in New York City and some other major metropolitan areas. But on general, rents are up, especially for single family homes that are in the suburban areas or outside some of these cities. And this is where we knew it was going up. So the fact that CPI primary rent year over year is at these levels, again, these are things that we continue to see pulling everything higher. And if you consider rent year over year on the left, you're talking about something that's up almost 20%. But yet, again, they keep telling us that CPI primary rent is down. Now, this is something that is obviously an average, as you can see how median asking rent can go up and down, and you're seeing some of this movement. But the surge is very real, and this is going to pull up the primary rent side of the CPI equation. Now let's look at ISI Homebuilder survey sales. So clearly we're making all-time new highs going back to 1995. So we have new sales. So obviously with new sales going up, prices are going up. We have the amount of inventory going down. When we talk about just mortgage applications, as we said in the previous show, we had mortgage applications were at 8.1%. I mean, the last month they were at they were down 4.1%, and now they're up 8%. Clearly, there is a movement. Now mortgages obviously also pick up refinancing, but the movement is in the positive direction for pricing. Now, this is, again, going to lead to an inflationary cycle when you look at just how do we calculate CPI and what is rent, and when you look at the mortgage side. Now, when we look at uneven savings across income quintiles, and that's why when we talk about the different percentages of where are personal savings, and when you look at 80 to 100%, are essentially anything from share of cumulative personal savings since March, it's very much weighted in the top two quartiles, where everyone else on the lower third continues to drain out of savings. So when we see money coming in terms of those $600, when this is where we keep talking about money not going as far, it's just going to go to rejuvenate what you've taken out of savings. And it's just trying to make you whole and keep you from going too deep into the hole from which you started, where all of this has come through. While on the other side, when you look at the personal savings, people have seen their expenses get less. They're working from home more, they're not traveling as much, they're not eating out as much, they're doing less with their money. So it is very much weighted towards the top of the savings bracket. And this is, again, coming to social immobility, inequality. This is where we continue to see this strife on both the Republican and Democratic side and their constituents. This is just a perfect example of kind of where that sits. And as you can see, March, April, everybody was saving money. But now as that one-time check left and as the unemployment benefits started to dwindle down, you can see that people on the lower third quartiles were pulling more and more out of savings. Again, leaving people behind. And just this quick cash is only going to bring them back to flat. It's not going to get them further ahead as the jobs market continues to, again, struggle to get back on its feet. And why is that the case? Well, let's look at small businesses. So small business revenue is still down 32.1%. And when we think about when was this struck, this was struck at the beginning of January. So January, we're down 32.1% on revenue. On small businesses open, we're still down 30%. So small businesses open still remain down, and revenue change still remains weak. And you can see the trajectory since June has been, it's slight, but there's still a downward move on revenue. And again, we're seeing prices go up. How much of those prices can get passed through to the consumer? How much of them does the company have to own and take ownership? So you don't have as much money to hire people back that you let go, or if you were able to open up your doors at all, which is again leading to small business jobs index for January. You can see that we're now down below where we were in 2009. The small business job side continues to struggle. And if you think about how much small businesses make up GDP in the US, this is a big problem. And this is going to lead to that overhang on how many jobs come back, how many people can actually get back into the workforce to try to get back to earning cash outside of their unemployment check. So when you look at the historical trends, so the one benefit that we have in January, even though the jobs index has gotten worse, is we're seeing some normalization. We're seeing a nice an uptick in weekly hours, in weekly earnings, and hourly earnings. So again, we're starting to see some of this flatlining, which is why when we look at the jobs index for January, we don't think it gets much worse in February. If anything, it probably gets a little bit better, but we're not going to spike back up. We're still going to kind of flatline at these levels, again, leading to this pain that we continue to see throughout the system, which is showing up in a different place. Let's look at Homebase, and let's look at through January into February so far. Again, flat. There's nothing moving up or down. We're just flatlining below where we were in December. And again, these differences are becoming a much bigger problem when you consider and factor in, seasonality and all these other pieces where we're just not getting back to where we were in December or November, and the pain is continuing to get worse and worse. And that's not something that we see changing anytime soon. Now, why is that? Well, let's look at search activity. Well, search activity deteriorated again in January. So when we look at job listings, jobs in education, resumes and portfolios, all of this is shifting down as people get discouraged, or people don't see as much, or they got their check from the government and it's more than they would make if they went back to work. So they're going to sit on the sidelines for a little bit longer. Again, all of this leads to a leading indicator for what we said previously, where we looked at January. January kind of sucked. It didn't do much better, but it's not going to get that much better in February either, just based on where things are flattening out at these depressed levels. And the search activity slides further below forecasts in the U.S. Now, the world has gotten a little bit better, still not where it was, but the U.S., again, that downward trend, that flatlining, that it just means that we just don't see the same type of turnaround. And then this, I thought, was a good chart of looking at the unemployment rate forecast. And you could see that spiked to 8.1%. And we're going to have that slow recovery in general, where we're just not going to really be able to get to those 2019 levels. And we can look at the Phillips curve and what does that mean. But just kind of simplifying it here, it's just going to be a painful, slow process where we realize some quick benefits. But again, as the economy on a global level really kind of flatlines and struggles, you're just not going to see this turnaround to hire new individuals, as we see more and more pressure on the inflation side. Now, when we look at zombie companies with short interest as a percentage of float, you can see GME all way at the top with GameStop. But again, a lot of people are, when we talk about degrossing and trying to restructure, but we look at U.S. hits all-time highs in zombie companies. Now, a zombie company doesn't really have the capacity to hire new people because they're just struggling to maintain some sort of cash flow to hold interest expense flat, so they don't have to issue more debt on top of rolling the current debt to stay alive. And if you just look at where we are in relation to everything else, you can just see how bad it is in 2020 versus any other year, which is why the percentage of the float has gotten so high, too high, and now you've seen that degrossing as people have pulled back to avoid some of this additional pain as the U.S. hits this all-time high in zombie companies, which again, we continue to see inflation expectations in another way. Now, we talked about prices. We talked about all of these different components that are leading and going to lead to higher prices, to inflation for the actual consumer. Well, the 5-year U.S. break-even continues to push higher. Now we're above where we were in April to cover that inflation percentage, and we think it's going to continue to push higher as we start to see some of these come through, and we see that pain overall. Now, wages, salaries, stimulus, unemployment benefits, welfare. When we look at wages and salaries, and again, wages and salaries have been under pressure. So this is coming from wolfstreet.com. You can sign up for the free newsletter. I highly recommend it. I think it's very well done in terms of some of their charts and information. So income from other sources in December inched down down 0.6% from November and fell by 1.7% from February. So when we think about supplemental wages such as employer contributions to benefit plans, that was up only 0.5%. Proprietors' income, farm and non-farm, was down 6.8%. Rental income was up 0.4%, and interest and dividend income was down 0.9%. So when we look here, wages and salaries have essentially been flat. We're right back to where we were, but this stimulus and what we saw coming through, which got pushed into the system, but at the same time, it's now we see people living out of savings. We see wages and salaries and really not doing anything. If anything, they're going to come under more pressure as more people look for jobs. So now let's separate that out. In another chart from Wolf Street, consumer spending on total. So consumer spending came down. Now, we had a strong spike from the bottom, but for all of 2020, durable goods spending jumped 5.6% despite that hole in the middle. For the 2020, spending on services dropped 5.4%. So again, when you think about the spending in total, spending on services came down a significant amount. And the reason why services matter is because the U.S. economy is a services economy. And that is a problem. So on the manufacturing side, on the durable side, we're importing that. We're a service economy. So if durable goods is up by 5.6%, which is 1.62 trillion, but then for spending on services dropped 5.4%, which is down 9.49 trillion. Again, that's a problem. They account for 65% of total consumer spending in December and includes rent, healthcare, insurance, plane tickets, education, hotel bookings, movies, wireless subscriptions. I know for myself, rents are up, healthcare is up, insurance is up, plane tickets, well, that's essentially free. Education is up, hotel bookings is down, movies are down, and wireless subscriptions are flat. So, when you think about where is this going to come to, yes, there's some of that is deflationary, but other pieces are way more inflationary. But the consumer spending is the problem, and it's facing the wrong direction. So when we look at personal spending estimates, the estimate for personal spending was supposed to be down 0.4% versus an actual of down only 0.2%. Personal income estimates were supposed to be 0.1 versus an actual of 0.6. Personal income is well above that 2008 cycle, while consumption is fairly in line with 2008. So when you look at just where is this going, it's the savings side, but services has been fairly flat. So durable is flattish. Savings, we think, is going to become a bigger component as they try to make up, because when we look at the movement from that spike in April and March, then you can see the savings starting to dwindle down in general as that money gets pushed back into the market in general, as we see here with weekly unemployment insurance benefits and FEMA supplemental payments for lost wages, we're shifting higher. So continuing unemployment has come down a bit, but you're seeing some of that pivot into the other. Now, when we look at what is the expectation for initial jobless claims, it's expected at 830,000. Right, based on kind of what we're seeing, some of the makeups, we should be fairly in line with that number as we look at, but again, we're still elevated with continuing claims expected to be at 4.7 million. In general, we still have about 19 million people overall receiving some sort of benefit. So when you have change in employment and spending, again, employment at the high wage side and spending at the low income side still remain at the elevated levels. But when we, again, talking about people, low wages, the unemployment is through a floor, even though their spending is still fairly elevated. So low employment is down, but spending is flat. Again, that inequality situation. Employment at the middle wage is a bit flattish in terms of where it is, where only spending at the income on the high income level is down, while the wages are fairly flat to up. Again, this is the bifurcation we're seeing in the market and continuing to push towards why we think there is this strife that continues to reverberate throughout the system. And that's when let's look at consumer sentiment. Well, consumer sentiment is down flattish with consumer expectations down as well with present conditions flattish. Again, moving sideways. We're not seeing much going forward. And as we broke out last time, in the different levels of sentiment, low income sentiment remains through a floor and continues to get worse based on all the different factors we're talking about, which is why, going back to the previous slide, when you think about that change in employment and spending, people are bleeding money at the low income level. So when you get that cash, which is where Biden has agreed to, or at least said that he would be a bit pickier or more strategic as to who gets that money, this is what he's looking at. This is what he's talking about. You need to give more money to this bottom quartile to try to close that gap because spending continues to be elevated even though they don't have those jobs. So again, this is what we were talking about with personal income. You can see, again, that flatlining nature of personal consumption expenditures, nominal dollars coming down, personal income, flattish in general. But we're just not seeing this turnaround in activity, which when we look at lower expectations for raises, people are not expecting those raises. And that's, again, coming fully down in general, like percent planning to raise wages. No. Net consumer confidence of a raise in 6 months, negligible, because the common quote that unfortunately I've heard before, and I'm sure others have as well, you should be happy to have a job. Well, why aren't you compensating me for what I'm doing? Because I'm doing more with less people there. And the people at this point are just happy to have employment. And companies, as we showed earlier, are still struggling to turn revenue, which again is just weighing on just the general activity in the market. And the Chicago business. So let's break it out into Chicago. So Chicago came in well above expectations at 63.8. So the business barometer was strong. Prices paid. So prices paid rose at a faster pace, signaling expansion. New orders rose, signaling expansion. Employment fell at a faster pace. So again, prices paid up, new orders up, employment fell. Again, just looking at the differences between the two sides. And inventories rose in the direction reverse. So inventories were up. Supplier delivery rose at a slower pace. Again, things starting to normalize a bit. Order backlog rose, number of components rising versus last month were 5. So some things are better. Some of that manufacturing is better. Employment was worse. Inflation worse. So again, still positives, but inflation's going to get worse and you're still not hiring people. Now let's look at Kansas City Fed. Again, prices paid through a roof. And you can see where we were versus 2017, 2018. This will normalize, not saying it won't, but we still haven't even begun to see the sheer extent of this in the prices. Now, we're starting to. Anybody who buys anything to survive, that you're seeing this increased pressure, but you're starting to see it now whittling through the system, and this will start to continue to bleed through that supply chain. which is when we look at trade. So trade continues to be a bigger component on import side. Again, not services on the import side. So we still have that net exports are negative, which is detracting from GDP growth. And we just don't see that really adjusting in the near term, given how we still have people buying durable goods, less services. So we're still going to have that net negative impact to GDP in general. But when we look at prices increasing in China and other areas around the world, going back to segment 1 of PMI inflation, again, it's global inflation. So our import prices will go up, which means that we're going to continue to see even more pressure to the upside. And as we showed earlier with that separation between prices paid in China and U.S. imports, we're going to see that reverberate through the system again. And that's why when we look at U.S. consumer spending recovery, when we look at total consumer spending, looking at the separation, durable goods slowed a bit, non-durable goods fairly flattish, services is the one that continues to be on the contractionary level and remains that pressure in general. So when we look at the continued claims from last week, this is what we were talking about with that total amount of people at about 18 million. Now, this is something where we think there's going to be a little bit of a step up from the 2nd to the 9th, because again, this is on a delayed. But the pandemic insurance, when we look at just in general, we're still over 10 million. This is what we continue to point to as the inherent problem. And we're going to get more data tomorrow. This is one that we think is going to remain elevated for another week as states continue to catch up. Again, this is some of the pressure in general. And even though we had some drawdown, some decline, here's just breaking it out from initial claims and pandemic UA initial claims, where we had that big spike into 29%, another increase of 2%, and now we declined 9%. But you can see we're still at those November levels. And just based on everything we've talked about so far in this segment, it's going flat, not down. And that's a net negative for just activity, which we continue to be concerned about as wages falter and inflation goes higher, and the pressure is going to mount on the inflation side. Now, the Fed can talk a great game, but I mean, based on all of that data, to me, inflation is going one way. And if you're not feeling it already, you're going to feel it. And it's going to be a very painful feeling, especially with limited income coming into the coffers to refill as you try to survive and live from savings.